What if I told you there's a line item on your retirement that you approved, but probably never actually saw? Not a scam, not fraud, fully disclosed somewhere in a prospectus you likely never read. You approved a 1% advisory fee. That part you know about. You probably didn't approve the 0.85% expense ratio inside the funds your advisor selected, or the 0.20 platform fee on top of that, or the trading costs layered below both. Added up, 2.05% annual drag on your retirement balance. On a $1 million portfolio, that's $20,500 a year, leaving your account silently every year, compounding against you for decades. Nobody showed you that number as a single line on a single statement. They never do. Today we find it. Welcome, welcome, welcome. You're listening to The Income Standard, where retirement income is designed, not guessed. I am Tod Long, and this is the show for people who are done accumulating and ready to start engineering. Let's get into it. Welcome in, folks. Today is a subject I like to talk about. It's something that comes up a lot in my discussions with retirees and pre-retirees, and it's fee leakage. Fee leakage is the compounding drag of multiple overlapping costs that are each disclosed somewhere, but never aggregated into a single number you can actually see and evaluate. Here's the anatomy of a typical fee structure for someone using a full-service registered investment advisor with a managed portfolio. Advisory fee. Typically, it's 1% of assets under management, or AUM. You'll hear that term a lot. This is the fee most people know about. It's typically the only one they negotiated at the start of the agreement. Fund expense ratios, which typically is 0.5 to 1.2%, depending upon whether the funds are actively managed or indexed-based. This fee is deducted directly from the fund. It never shows up as a line item on your statement. It simply reduces the fund's return before you even see it. Platform or custodian fees, typically about 0.1 to 0.25% charged by the platform holding the assets. Often it's bundled into the advisory relationship, but technically it's a separate fee. Now you total that up together, that's 1.6 to 2.45% annually. On a $1 million portfolio, that's between $16,000 to $24,500 per year, every year, leaving your retirement to pay for someone else's infrastructure. Over 20 years, assuming 6% portfolio growth, the drag of a 2% annual fee reduces your ending balance by approximately $340,000 on a $1 million starting portfolio. That's not what you paid in fees. That's the compounding opportunity cost of what those fees would have been worth if they stayed invested. Fee drag doesn't show up as a line item. It shows up as a smaller balance at 85 with no explanation attached. Here's what makes fee leakage specifically dangerous in a retirement income context, as opposed to just an accumulation efficiency problem. During accumulation, fees reduce your ending balance. That's bad, but it's a clean calculation. You end with less than what you would have. In retirement, fees do something worse. They increase your effective withdrawal rate. So if you need $50,000 a year in income from a $1 million portfolio, your stated withdrawal rate is 5%. But if your annual fee drag is 2%, your effective withdrawal rate, the total percentage leaving the portfolio every year between income and fees, is 7%. That's a meaningfully different depletion trajectory. A 5% withdrawal rate has a reasonable probability of sustaining a 30-year retirement with modest returns. A 7% effective withdrawal rate has a significantly lower probability, and nobody showed you the difference. Every dollar in fees is a dollar that can't generate income. Every year of fee drag is a year of compounding working against you instead of for you. The income equivalent framing is the one that actually lands most clearly. A 2% annual fee on a $1 million portfolio is $20,000 a year. At current annuity payout rates, $20,000 a year in guaranteed income requires approximately $200,000 to $240,000 in principal, which means the annual fee drag on a $1 million portfolio is equivalent to the cost of purchasing $200,000 to $240,000 in guaranteed lifetime income every single year, not over 20 years, every year. That's not an argument against paying for good financial management. It's an argument for knowing exactly what you're paying and making sure every dollar of cost is aligned with an income outcome. I want to spend a minute on why fee drag is so pristinely invisible, because the answer isn't just that advisors hide it. The architecture of the financial services industry makes fee transparency structurally difficult, not impossible, difficult. And here's how. Your advisory fee shows up on your statement because the advisor charges it directly and is required to disclose it. That part is visible. Your fund expense ratios are disclosed in the fund's prospectus, in the SEC filing, in the fund fact sheet, but they're deducted from the fund's net asset value before you see it. They reduce the fund's daily price. Your statement shows you a return, but it's a return already net of the expense ratio. You never see the gross return minus the fee. You only see the results. Your platform fee is often bundled into the advisor's relationship or charged as a small annual account fee that appears once a year in small type. In a quarterly statement, most people don't even read past the first page. So the total fee picture, the number that actually matters, the number that tells you what your retirement is paying for someone else's infrastructure every year, exists only when you add up 3 separate disclosures from 3 separate documents that no single retirement statement presents together. Most people never do the math. Most advisors never do it for them. The question isn't whether your fees are disclosed, it's whether they've been shown to you as a single annual dollar amount against your specific retirement income needs. If you've never seen your total annual fee as a single number, and you've never seen that number expressed as a monthly income equivalent, you haven't seen your full retirement cost picture. That number should be on paper, and you should know it. The income standard evaluates every fee in your current financial structure against one question. Is the cost aligned with the guaranteed income outcome? That doesn't mean fees are inherently wrong. Active management fees can be appropriate when the management is genuinely active and the performance justifies the cost. Advisory fees can be appropriate when the advisor is delivering meaningful planning, not just portfolio monitoring. What's not appropriate, and what the review specifically identifies, is fee drag that provides no income protection, no longevity guarantee, and no sequence of returns buffer. Fee drag that reduces the portfolio available for income engineering without contributing to the income floor. The fee leakage scan in the income standard review calculates your total annual fee across all instruments, advisory, fund, platform, and any other cost layer, and presents it as 3 numbers: annual dollar cost, 20-year opportunity cost, and monthly income equivalent. Those three numbers tell you whether your current cost structure is a reasonable investment in your retirement outcome or a quiet drag that's been running against you for years. We are at the halfway point, and I want to give you a tool to use. We've been talking about fee leakage, the invisible drag that compounds against your retirement balance across advisory fees, fund expense ratios, and platform costs. The number most people don't know because nobody has ever shown it to them as a single total. The fee drag calculator on the resources page at theincomestandard.com shows you that number. You enter your portfolio balance and your total fee percentage. Or if you're not sure of that total, you can enter each component separately: advisory fees, fund expense ratios, platform costs. The calculator shows you what that fee structure costs you annually, what it compounds to over 10 and 20 years, and what that same money would generate as guaranteed monthly income if it were redirected towards closing an income gap instead. Most people running this for the first time find that their total fee drag is meaningfully higher than they thought, and that the 20-year cost represents a significant income opportunity they didn't know they had. If you're in the car, come back to it later. If you have 4 minutes now, go find your number. Theincomestandard.com, resources, fee drag calculator. I'll be here when you get back. So let's walk through a real story, real scenario. Of course, as I state every week, the names have changed to protect their privacy. So we have Mark and Linda, 64 and 62 years old. They have $1.35 million in combined retirement accounts managed by a full-service advisor they've worked with for 11 years or so. They trust him. He's done fine. Their fee structure, 1% advisor fee, disclosed clearly. They knew about that one. When we ran the fee audit, here's what we found. Their portfolio was invested in a mix of actively managed mutual funds with an average expense ratio of 0.78%. Their custodial platform charged 0.15% annually. Total fee structure, 1.93% per year. Now, on $1.35 million, 1.93 is $26,055 per year in total fee drag. Mark and Linda thought they were paying $13,500 a year. That's that 1% advisor fee they knew about. They were paying nearly double that. 20-year opportunity cost at 6% compounding, approximately $485,000. That's not what they paid in fees over 20 years. That's what those fee dollars would have been worth if they stayed invested. Monthly income equivalent, $26,055 annually, is approximately $2,170 per month. At current annuity rates, that monthly income stream requires roughly $260,000 in principal to generate, guaranteed for life. So Mark and Linda were paying the equivalent of $260,000 in guaranteed lifetime income every year in fee drag. Not to a product that guaranteed them anything, to the cost of running their portfolio. Here's what we restructured. We moved a portion of their portfolio, $300,000, into a fixed indexed annuity with a lifetime income rider. No advisory fee, no fund expense ratios, a guaranteed $2,400 a month in income for life with principal protection from market losses. The remaining $1.05 million stayed in a simplified, lower-cost investment structure, index funds at 0.07 average expense ratio, direct held through a flat fee custodian at $500 per year. Total fee on that portion, roughly 0.12% versus the previous 1.93%. New total fee picture, $1,260 per year on the investment side versus $26,055 previously. That's $24,795 in annual fee savings, which funds approximately $2,066 per month in additional discretionary income. They didn't earn more money. They stopped paying for what wasn't working for them. Mark and Linda's trusted their advisor, and their fees were fully disclosed. The problem wasn't transparency. It was aggregation. Nobody ever put all three fee layers on a single page and shown them the income equivalent. If that's where you are, that's the number that this review produces. Let me show you what staying in Mark and Linda's original fee structure costs over the remainder of their retirement. So year one, $26,055 in fees. The portfolio is healthy. It's barely noticeable against the $1.35 million balance. Year five, cumulative fees is $130,000. The portfolio has grown, let's say, to about $1.5 million, so the fee percentage is still stable. The absolute dollar amount has grown to $28,950 annually. Still doesn't feel like a crisis yet. Year 10, the cumulative fees paid approximately $280,000. And here's where the compounding silence becomes audible. The $280,000 in fees that left the portfolio over 10 years would have compounded to approximately $375,000 if it had remained invested. That gap, the $375,000, never shows up on any statement. It's simply not there. Year 20, the portfolio that should have reached $2.4 million at 6% growth has reached approximately $1.9 million because $500,000 in compounding opportunity cost was quietly extracted in fee drag over 2 decades. Not in a line item, not with an explanation, in the daily reduction of fund NAV and the annual advisory percentage that felt routine. That $500,000 gap, measured in income at 5% withdrawal rate, is $250,000 a year in retirement income that doesn't exist because the fee structure was never audited. That's not money that was stolen. It's money that was quietly, legally, fully disclosed, paid for a cost structure that was never evaluated against the income it was supposed to support. The fee audit doesn't cost you anything. Not finding it costs you everything it would have been. If you've never seen your total fee as a single dollar number, and you've never run the 20-year compounding calculation on that number, you haven't made a fee decision. You've accepted a default. Those are different things. Fee drag is the most correctable of the retirement income risks covered on this show. Sequence risks depends on market timing. Longevity risk depends on biology. Fee drag depends on a decision you can change. The income standard review includes a fee leakage scan. We identify every cost layer across your current portfolio aggregated into a single annual dollar number, project the 20-year opportunity cost, and evaluate whether each fee is aligned with a guaranteed income outcome. If the cost structure is appropriate, if the fees are earning their place in your retirement plan, we'll tell you that. If there's a meaningful opportunity to redirect fee drag into guaranteed income, we show you exactly what that looks like with your numbers. Schedule your fee audit at theincomestandard.com. As always, no cost, no obligation, just the numbers you should have been shown years ago. That is the income standard for this week, folks. If this episode gave you a framework you didn't have before, share it with someone who actually needs it. Forward it to a friend who's 5 years from retirement and still thinking in terms of balance sheets instead of income architecture. And if you found yourself thinking about your own income floor while listening, like what's guaranteed, what's not, and what that gap might be, that's the signal. That's when this review makes sense. The review is waiting for you at theincomestandard.com. Again, that is theincomestandard.com. There's no cost, there's no pitch, just measurement. I'm Tod Long. We'll talk to you next week.